In this video, you are going to learn how professional traders analyze market structure, identify directional bias, and avoid getting trapped in choppy and confusing market conditions. We will break down the core principles behind recognizing trending and non-trending environments, identifying protected highs and lows, distinguishing major swings from minor swings, and using higher time frame analysis, liquidity sweeps, change of character, and Fibonacci-based structure validation to understand the true direction of the market. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let's begin with the first core principle, which is learning how to recognize and deal with choppy market conditions. A choppy market refers to a market environment with no clear direction, where price constantly swings up and down in an aggressive and disorganized manner. Trading during these conditions can become frustrating and complicated because the market shifts direction unexpectedly and produces many misleading signals. So, why does this type of condition happen? Usually, this takes place when market movement is heavily influenced by news flow, especially when a large amount of negative information starts coming from one country and then from another, while capital continuously moves in and out of the market. So, is there anything traders can actually do during these conditions? Yes, absolutely. But before anything else, remember that there is no reason to force yourself into a poor quality trade. What we can do instead is remain patient until the market hype settles down and price action becomes cleaner, clearer, and easier to interpret before taking any risk. Learning how to wait for high-quality setups while avoiding low-quality trades is one of the most valuable skills a trader can develop over time. During choppy market conditions, we usually wait for what is known as the choppy range breakout. Let me explain how this setup works. Here we are looking at EUR/USD on the 5-minute chart. The most recent price action is extremely choppy, with no obvious trend or clear directional movement. The first step is to identify the chop range by marking the highest and lowest points of the recent price action where sharp reversals occurred. At this stage, we can say that we are only interested in trading if price successfully breaks outside of this range. If price breaks above the range high, it suggests that buyers have gained control and that the directional bias is now bullish. On the other hand, if price breaks below the swing low, it indicates that sellers have taken control of the market, and we will begin looking for potential selling opportunities. If you are still uncertain whether the choppy condition has truly ended, you can also zoom out into a higher time frame, such as the 1-hour chart, and identify the choppy range from that perspective as well. On this higher time frame, once again, we define the range by using the most recent important high and important low. Here, we have a recent low, so we can mark that level, and over here, we have the recent high. Now we can say that if price manages to break above the high of the range, we can zoom back into the 5-minute chart and search for buying opportunities until price reaches this unmitigated supply level sitting ahead of the current market price. There is a greater probability that price experiences a strong rejection at this point, which is why it would become our longer-term target. Conversely, if price breaks below the lower boundary of the range, we can move into lower time frames and search for selling opportunities, because this shows that selling pressure has become stronger than buying pressure, giving us a bearish directional bias. So this is the overall approach for dealing with a choppy market structure. Another very important detail to understand here is that if you cannot clearly identify what price is doing at the moment, it may simply mean that you are analyzing the wrong time frame. For example, on this same chart, notice how the 5-minute structure looked choppy and confusing for any trader trying to enter a position. However, once we zoom out into the higher time frame, we can clearly see that the overall market direction remains bearish. The latest movement has swept liquidity resting above these equal highs, and the combination of a bearish trend together with a bearish liquidity sweep creates a strong indication for downside continuation. So always keep in mind the importance of checking the higher time frame structure in order to understand the real market direction and avoid getting trapped inside lower time frame noise and random fluctuations. Now let's move into the second core principle, which is learning how to identify market direction and turn imperfect trending conditions into something much clearer and easier to understand. We already know that in a clean bullish trend, price continuously creates higher highs and higher lows while respecting the previous swing lows. Whenever price breaks above a previous high and forms a new structural high, it confirms continuation in the trend. At that point, we mark the lowest point responsible for starting that impulsive move as the new higher low, also referred to as the protected low. As long as price remains above this level, buyers continue controlling the market, and we should focus only on buying opportunities. Once again, price pushes higher and forms another breakout, creating a fresh structural high, and we continue maintaining a bullish bias as long as price respects the newly protected low. The reason why this protected level matters so much is because if price revisits that area, buyers will likely step back into the market to defend their positions once again. But what happens when price fails to create a new high and eventually breaks below the previous swing low? This type of behavior suggests that buyers are losing control and that strong selling pressure is beginning to enter the market. This transition in market behavior is known as a change of character, and it often acts as an early warning sign of a possible reversal. In other words, it suggests that the current trend may be weakening and that a move in the opposite direction could soon develop. However, during imperfect trending conditions, price can sometimes generate a false change of character and still continue moving higher afterward. This is one of the situations that confuses many traders, especially those who assume the uptrend is finished and enter short positions too early. Here we have an example showing how an imperfect trending market may appear. Initially, price can look messy, inconsistent, and without direction. But once we apply the fundamental principles of identifying market direction, the structure becomes much more readable and organized. The main idea here is that in imperfect trends, your attention must remain focused on the overall structure, rather than reacting emotionally to every small breakout or short-term movement. Always remember that many of these smaller reversals are temporary and often exist only to trigger stop losses or gather liquidity for retail traders before the main move continues. Now we arrive at the third core principle, which is understanding the difference between major swings and minor swings within market structure. When does a swing high or swing low truly carry importance? And when should it be considered weak within an uptrend? Major swing lows are the key zones from which breaks of structure originate. This level represents the highest price recently achieved after taking out a previous high, meaning that the beginning of that impulsive movement defines our major low. A change of character occurs when price breaks below this specific level. All remaining swing lows are classified as minor, and a break below them does not necessarily signal a real reversal. Now, here is another critical concept to understand. A level can only be classified as a major swing after a valid break of structure has already taken place. For example, this low cannot yet be considered a major swing low until price delivers a confirmed break of structure. This level represents the highest price recently traded, and a break of structure only becomes valid once price clearly pushes through that area. As mentioned previously, only after a valid break of structure occurs can a level officially be labeled as a major swing. Because of that, this level becomes the major swing low, while the others remain classified as minor swings. Now let us move into the live chart example and apply these basic directional principles to determine the directional bias correctly. Here we are looking at Euro USD on the 15-minute chart. We can identify a 1, 2, 3 movement followed by a breakout to the downside. This allows us to define our high, low, lower high, and lower low structure. Once again, price breaks lower and creates another new lower low. We then mark the origin of this impulsive movement as our protected lower high. As long as price remains below this level, the market direction stays bearish, and we should continue focusing only on short opportunities. But now, an important question appears. Is this truly a major structure, or should this movement actually be treated as a single leg? In other words, should we classify this as a valid correction, or is it simply market noise that deserves to be ignored because the pullback itself appears relatively small? The reason why this distinction matters is because if we classify the movement as a single leg, then this swing high becomes our protected high, and breaking above this smaller minor swing would not necessarily confirm a reversal. To determine whether this pullback qualifies as a valid correction, we can use a simple method. We take the Fibonacci retracement tool and apply it from the beginning of the move to the end of the move. If the correction reaches the 0.382 level, then the pullback is deep enough to be considered a valid structure. Otherwise, we classify it simply as noise within the market. So in this particular example, it qualifies as a valid pullback. Once again, we can see another breakout to the downside, creating a fresh lower low and a new lower high. Following the structure on this chart, we now notice that price has broken above a protected high, which suggests weakness inside the bearish trend and signals the possibility of a reversal forming. However, this is still not a convincing breakout. Notice the long wick left behind, showing that sellers reacted aggressively and entered the market very quickly. This movement looks much more like a liquidity sweep above these equal highs, and price may still continue moving lower afterward. Because of that, in order to confirm a true trend reversal, we still need additional confirmation. If price manages to break above this recent high, then we can become much more confident that market direction has genuinely shifted. So now, let us see what happens next. At this point, we finally have a strong reversal signal, showing that the market structure has transitioned from bearish conditions into bullish conditions. So now our directional bias on this pair becomes bullish, and we can begin searching for buying opportunities. Here on the EUR-JPY 1-hour chart, we can identify a 1, 2, 3 movement breaking above the previous structure. This gives us our high, low, and higher low formation. The directional bias remains bullish as long as price continues trading above the protected low. So now let us continue playing the chart forward. At this stage, we can see that price produced many fluctuations and unstable movements, but eventually managed to break above the previous high and create a fresh structure. Because of that, the lowest point responsible for creating this breakout now becomes our new protected low. Once again, the market remains bullish as long as price stays above this protected low. Now, as we continue moving the chart forward, we can see another breakout to the upside, creating a new structure. But here comes an important question. Should this movement be considered a valid correction, or is it simply market noise that should be ignored? To evaluate the depth of this pullback, let us apply the Fibonacci retracement tool from the previous low up to the recent high. Now we can clearly see that the correction failed to reach the 0.382 Fibonacci level. Because of that, this cannot be considered a valid correction. Therefore, we are going to classify the entire movement as a single price leg. However, this retracement could later act as an inducement level because it formed near the 0.382 retracement of the impulsive leg and also created an equal low structure. This means that on the next pullback, price may temporarily sweep this inducement area, moving slightly deeper below the discount zone before continuing higher. And that is exactly what happens here. Price takes the inducement liquidity, retraces into the fair value gap positioned inside the premium zone, which becomes a very attractive area for a long opportunity. As you can see, price then reacts strongly from that area, pushes upward, and eventually reaches the target. Now, let's move into the final core principle, which is understanding when not to trade and how to manage risk during uncertain market conditions. Whenever price action starts behaving irrationally and market sentiment appears unnatural, that is usually the moment when it is better to stay away from the market. Price prints a strong bullish momentum candle but fails to continue higher. Then, it creates a change of character suggesting a move lower, yet price still fails to continue downward. These are classic signs of an unstable and highly choppy market environment. Even after learning all of these core principles for identifying highs, lows, and market direction, it is important to understand that no concept works perfectly all the time, because price action only reflects past market behavior, and the past alone can never fully predict the future. However, price action still provides valuable information about what is currently happening in the market. Because of that, whenever market structure becomes unclear and directional bias is difficult to identify, the best decision you can make is to stay away from the market and avoid forcing unnecessary trades. By respecting your risk management rules, limiting your exposure to only 1 to 3% of your capital per trade, and patiently waiting for high-quality setups aligned with your trading plan, you can protect yourself from major losses and avoid unrealistic expectations that no trading strategy can consistently deliver. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Comlucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the Comlucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and CHoCH. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.